If you're a buyer or investor here in Bryan-College Station, you might feel frozen by the local housing market. That's right, lots of inventory, high prices, pesky interest rates. It's not helping the situation. You probably feel like, hey, I'm missing out on a great deal, but also, what if the market continues to soften? Is there a better deal around the corner? Or even worse, is this market going to implode? I get this question, this concern from clients every single day. So I'm going to take the next few minutes to break down the local housing market for you so you understand exactly what's going on, where the opportunities lie as a buyer or an investor, but also as a seller, how you can survive a very, very difficult market. This is your July 2025 market update. And my name is Greg Schwartz, and this is your favorite channel, Investing in Bryan-College Station. Guys, let's get into it. See what's going on in our local housing market. In this video, we're going to cover local market data. We're going to cover why mortgage rates dropped at the beginning of August. We're going to talk about how a jobs report can affect the housing market. And lastly, I'm going to give a scenario that could break the stalemate between the buyers and sellers here in Bryan-College Station. So let's jump right into the local housing market numbers. Of course, we always start off with the median sales price. Currently $339,990, and you might note that that is up by 4.8% compared to the year prior. That's right, prices have appreciated. It's still Bryan-College Station, it's still a sought-after market, but this can be slightly confusing because I'm about to tell you that we're in a slowing market despite the appreciation. It's all part of the standoff, guys. Our closed sales are relatively low, 342. Unfortunately, that's down from last month by 14%. So fewer buyers are pulling the trigger on houses. Active listings are up. In fact, we hit a new record again this month. We hit a record last month, a new record this month. 1,340 active listings, up 19% year over year and up 1.2% month over month. So, because the buyers aren't buying, but sellers are still listing the houses, the active inventory, the number of active houses on the MLS continue to build. As you can imagine, months of inventory are still relatively high. We're steady compared to last month at 4.8, but we're up 14% year over year. Steady continued growth of months of inventory, indicating more and more of a buyer's market. So let's break down, what does this mean? Well, demand is soft, driven, as you can imagine, by the high interest rates. But people still need to sell, right? They want to list their houses. Housing prices are still pretty high, so if I'm a seller, I'm going, hey, my neighbor sold their house for $500,000. Maybe I can sell my house for $500,000. The problem is there's just not a lot of buyers out there. So it's not just that the one house sold for $500,000. It's the fact that there's 10 houses in that neighborhood all trying to get $500,000, and the buyer gets to pick his favorite one amongst the 10, and that's the one that actually sells for $500,000. Hopefully that makes sense, but that's basically a summary of the stalemate. Lots of houses to choose from, not a lot of buyers. The few buyers that do exist are usually willing to pay at or above what the prices were in 2024. And that pretty much summarizes our housing market. So we said that the buyer activity, the stalemate, is largely impacted by mortgage rates. So let's talk about mortgage rates. As of August 8th, the average 30-year fix, according to Mortgage News Daily, 6.57%. And the good news is that that is one of the lowest rates we've seen in all of 2025. The bad news is it's not as low as the mortgage rates we saw around this time last year when we got down to 6.1. Here's why that's important. I believe, from my observations here in the local Bryan-College Station market, we need mortgage rates to get into the low sixes. I'm talking 6.25 or below before we see a noticeable increase in buyer demand. And it's that buyer demand that will break the housing market stalemate, the standoff that we're facing right now. The question you need to ask yourself is, well, why did rates come down almost 1/3%? And will that trend continue? And for that reason, we're going to turn to the local jobs market. That's right, I said jobs market. This is about to get pretty technical, but don't worry, I created a PDF just for you. Go down in the description below, follow the link, Give me your email and I will send it to you personally. This PDF breaks down all of the data points, both national and local, that I watch on a regular basis to create these kind of videos so that this way you can follow along at home and create your own opinion. All right, that being said, let's jump into this jobs report and explain why it was so ugly and why our mortgage rates are going down. So the jobs report is released by the Bureau of Labor Statistics. And one of the important numbers in it is both the unemployment rate, which is holding steady right about 4.2, but also job openings. And that's where we saw a major decrease this month. For starters, the expectation, the prediction was that we would have 117,500 new job openings in July. But the report came out, said we only created 73,000 new jobs. That's a major miss, an indication of a slowing economy, right? We were a lot less openings than expected, indicates slowing. But even worse than that, there were revisions. You see, the BLS receives data and they go back to their old reports, their old numbers, and they revise them with new data, as they should. We appreciate that. Problem is that revision was pretty ugly for the US economy. For example, in May and June, the job openings that were reported were 144,000 and 147,000 respectively. That indicates a pretty strong job market. The revisions slashed those openings down to 19,000 and 14,000, indicating we basically created no new jobs in May and June of 2025, indicating a huge slowdown to our local economy. The next number that we're going to want to watch is that unemployment rate, which has been holding pretty steady in the low 4s, but if that starts to tick up, that'll be another major crack and slowing down, indication of slowing down of our US economy. The question is, how does this tie back to mortgage rates and us here in Bryan-College Station? I'm glad you asked. The slowing job market indicates a slowing economy. We get that. That indicates that there's less inflationary pressures, less chances that we have inflation if the market and the economy is slowing down. It increases the chances that Federal Reserve decreases the federal funds rate, which is one of the tools they have to spur on the economy. In times like this, we also see that investors flock to 10-year treasuries. They buy more 10-year treasuries because it's safe in an uncertain time. But when you have that much demand, it lowers the yield on the 10-year treasury, and the 10-year treasury is very directly related to the mortgage rates that we know and love. So decreasing yields on a 10-year treasury decreases the 30-year mortgage interest rate. And of course, if we decrease the interest rate, like I said, below about 6.25, we increase buyer activity here in Bryan-College Station, effectively breaking the stalemate between buyers and sellers. I told you that was a little confusing. Don't worry, the PDF makes it real simple for you to follow along. So the question now you might have is, where are opportunities, Greg, here in Bryan-College Station? Well, the truth is, as a buyer right now, and you're buying for yourself for your primary home, you have a lot of houses to choose from. So if you ever want to buy the house of your dreams, there's 1,300 houses to choose from. I'm betting you can find the perfect one. If you're an investor, there's 1,300 houses out there. Surely there's a motivated seller. We're seeing a lot of weakness in neighborhoods where there's new builders, specifically new builders providing incentives, and then existing homes in those neighborhoods having to slash prices. We're also seeing a lot of weakness in condos, specifically the student condos, because for the most part, that's like a secondary home for most people. So there's not a lot of investors looking for those secondary homes right now to put their son or daughter in. So condos and the newer build communities are where we're seeing most of the weakening. Also at the higher end. So if you're looking for $1 million house, you might be able to get it for $800,000. Hit me up. My contact information is in the description below. I'd love to help you out here at Schwartz Realty Group. All right. What about my sellers? Guys, sellers, you're having a tough time right now. It's a very tough market with a lot of competition. 1,300 competitors in the market right now. So you need to do a number of things. One, you need to make sure that house is in the best condition it's ever been. Better than when you bought it. Buyers want perfection and they are able to choose the perfect house. Then you need to make sure it's priced right. You're competing with your neighbors. It used to be there was only one house for sale in your neighborhood. Now there's 10. You need to price competitively relative to your neighbors. Otherwise, buyers won't even look at your house. Price is the strongest marketing tool you have. And then lastly, you might want to consider providing incentive incentives to these buyers, like buying down their mortgage rate, which of course is the major thing holding them back from buying a house right now. If you do all those things, sellers, you still have a good opportunity of getting a strong price for your house. And let's be honest, you've had a lot of inflation, a lot of appreciation over the last 3 to 4 years. So you have a lot of equity built up. That's the good news in all of this. In summary, guys, the market's in a stalemate. We have a lot of active inventory, not a lot of sales happening. Buyers are able to pick the perfect house for them. The stalemate is a result of high interest rates, and the high interest rates recently dropped by about 1/3% due to the jobs report, which, if it continues to be soft in the upcoming months, could indicate further decreasing of mortgage rates. And in my opinion, we need to get to the low 6s, maybe even as low as 6%, before we see enough buyer activity to change the market. But most importantly, your takeaway is that you need to subscribe to Investing in Bryan-College Station so that you can grow your wealth through real estate right here in Aggie Land. And you should probably hit that like button so you can let your friends know this is a great video. And then lastly, until next week when I drop my next video, you need to take it easy.